I say one of the things that I'm always forced to do is show a delta year over year. Do you have that in your?
I have an hour-long lesson on step-by-step, column by column, how to put together a financial model. So I'm not showing you that one today. There's a book for that. There's a video online for that. And I assign that as homework to them. Yes, in that one I show once you're up and running and have been around for over a year, please do year-over-year comparisons. And before that, do month-over-month comparisons.
So when you went through this morning?
Yeah.
What did Ed of Built Accounting have to say?
He helped chime in a few places, but he did not give me a huge amount of pushback. That was a little surprising, but I did get much more on the other side. I got a few people who said I can't keep up. Like, I'm not good with numbers. I can't keep up, and I've seen that before as well.
Sure.
And I can't. If I teach to the slowest person, then it would take forever. I have one of my favorite anecdotes from Fledge is I did this assignment. The entrepreneur went off, asked no questions, went off, did their financial model, sent me the first year, and I get it, and it looks pretty good. Like, physically, it looked reasonable to look at. The numbers looked reasonable. But when I scanned it, like, I just pulled it up in Excel and I started going down the first column, which is what I usually do, there were no formulas. And so I thought, okay, he's in Africa, so he did it in Google Sheets and then exported it in some Word format. And so we lost the formulas. And so I asked him that on the next office hours, and he's like, formulas? So he didn't know what a spreadsheet did. He knew what a spreadsheet kind of was, but didn't know what it did. And so he sat there with a calculator for like 3 hours doing one.
Jeez.
So I do try and mention that now before it happens, because you take these things for granted.
Looney, what happens if the entrepreneur attending the workshops relies on their accountant or something to handle all the finances? Do they have, like, if they're good with numbers, they don't want to do the modeling themselves? Like, how does that work?
Yeah, the way I explain to the entrepreneurs, which is not the answer they want, is if you're going to raise money, and they all want to raise money. If you're going to raise money, you have to do the financial model yourself. You can't go and hand it to even your financially oriented co-founder. You have to sit there and do it, because not every investor's like this, right? When you get to experienced investors, there are some that are money or numbers oriented. There are some that are product oriented. There are some that are sales oriented. There's like whatever their experience is, but there's a subset of investors that do analyze all the numbers. And if you get one of those and they say, let's pull up your financial model, you get to the financials sheet on the pitch deck, and you go, oh, okay, can we dive in that? The answer has to be yes. You can't be, well, let me bring in my accountant to answer your questions. The CEO has to be able to answer the question. They have to be able to pull up the financial model, and they have to be able to answer any question asked of them of any cell in the entire spreadsheet. So because of that, I tell them I will not give you a template. So I do not hand out templates for financial models. I tried that in the past, and the problem was they didn't understand why that cell had that value in it, because it was a formula they didn't write themselves. And I've seen this happen where an investor comes back to me and goes, well, he just doesn't know his business, right? And that's just simply from, not because he doesn't know how to sell a chicken, because he doesn't know why cell, D42 has the number 12 in it. And so, unfortunately, they're gonna have to suck it up, and they're gonna have to actually do the financial model. And when we do it in person, it's really easy to prove that, because I'm sitting there with them. When we do the online version, it's much, much harder. Yeah, and then in real life, when they're running their business, if they have a co-founder who's an accountant, that's great. If they have an accountant on staff, that's way better than having an external accountant. But it doesn't, too often that means they get the accounting statements, 20 days or 30 days after the end of the quarter, and that's the only time they ever see them. And that's just not how you run a successful business. for how you run a growing, successful business.
So when you do a financial model, there are numbers that you put into the model that you don't really know. You don't have the data.
All of them, yeah.
And how do you trust the answer?
Okay, so this is why, yeah,
Out of your ass.
this is the quintessential question of financial modeling. Every number is made up. Every single one. None of them are true. All we know when we're done with the financial model is that every single number is wrong. Okay, that's the truth. But if you have in fact done some research in that industry and know the industry, and you have iterated on this model 20 times to question every single cell in every cell in every tab, and if you've made the model as simple as it can be, no more complex than it needs to be, then it has the fewest number of errors in it, and it will tell you within an order, you know, well within an order of magnitude. It should tell you within a factor of 2 or 3, will this company ever make money? If so, how much money will be needed to do that? And when will it hit break even? Those are the three key questions. You will be wrong on your revenues. They will be too high, even though you're questioning them over and over again. Somebody did some research. I haven't seen this updated, but someone did some research that said 1 out of 300 startups exceeds their financial model. And just be aware when they're pitching you their finances, 9 times out of 10, they're going to say, these are conservative estimates. That's the key word, is conservative. I got some people chuckling who've heard this before. They're not conservative estimates. They're the best guess they have, and they're off by a bit. They're too high. And then they're going to forget some expenses, or things are going to pop up that they didn't think of. So expenses are going to be higher than expected. And so between those two, they're going to miss their numbers by something. Factor 2, factor 3. If they're off by more than that, they're going to fail completely. So it's going to take them more money and more time to do what they want to do. That's what we know as investors. And no matter how many times we tell them they're supposed to be optimistic entrepreneurs, they dismiss us for telling them that. And then a year later we say, oh, well, remember that financial model? It said you were going to be $1 million this year, and you're at 250, 300. And then they'll give you the reason why. And then you'll just nod and go, yeah, well, I expected that. I didn't expect $1 million. I was hoping for it, but I wasn't expecting it. And that's just that's how the actual game is played. When I was doing venture scale companies and we would go down to the valley to raise money, they would take our financial model and they would take out all of the revenue for the year. And they could do this in their head because they did this multiple times per day. So they would have the model, and it would just be revenue, expenses, net. And they would say, okay, well, let's just assume you don't have any revenue this year. Can this company, with the money you're asking for, run for the next 12 months? If not, you're not asking for enough money. And so that's not because they didn't think we're going to have any revenue. They did that to stress test the model to see how bad can it be. Or
19 situation.
is what?
COVID-19, no revenue for a year.
I don't think that's why they were doing it, because they would also do, okay, let's just take the revenue down by half. And let's see what happens then. And let's see what the difference is. So you have your model that says you have, let's say, 18 months of runway. If we take the revenue and cut it down by half, you get to 15 months of runway. If we take out all the revenue, you get to 9 months of runway. Well, you need to raise a little bit more money. We want that worst case runway to be 12 months. And so worst case is we're giving you enough money for 2 years. Like, that's not terrible for a venture capitalist to do this. But the first thing they would do with your model was to whack down your revenues. And just be clear, when they do the half revenue test, that's probably what's actually going to happen. That's more of a realistic case.
Zero revenue where we are at now.
And we would laugh at them, and then a year later we would say, "Well, look at that." Not that they were right, but they were much closer to what we thought was going to happen. And this is after 20 years of experience of building models and being optimistic entrepreneur. You want optimistic. You don't never invest in a pessimistic entrepreneur. That's a losing cause.
I had some questions on the capital expense part of your model.
Yeah.
The capital expenses come in huge lumps.
Yeah.
So do you add that big lump in that month?
Oh, okay. So this is the difference between cash accounting and accrual. So I just sent some money to Lima in Tanzania at Rogoth Dairy. He bought something. I got a picture of it. I don't know what it is. He said it's useful. Okay. I trust that he knows what he's doing. It's attached to a refrigerator. I think it might be a cooler or something. I don't know. It doesn't matter. He needs it, right? So he bought it. Well, he spent cash to do that. Like,
Right.
we collectively invested $20,000 in this company. We like him and believe in him. And so we trust that he's buying the right piece of equipment. He had to take, I don't know, let's call it $12,000 and send it to China or India or Europe to buy this piece of equipment. That $12,000 is no longer in his bank account, right? So it is
Right.
in the capital expenses as $12,000 in the month of April or May, whenever he made the purchase, right? And that's the truth. That's what actually happened. You know, this piece of equipment hopefully will last for years. In the accrual accounting system, you would accrue the value of that over a certain number of years, ideally the length of time it lasts, even though you don't know how long that is. In the tax system, you're required to depreciate the value of that over a specific number of years, depending on the tax law in the country you're in. Those are both fictions. You can't spend that depreciation on the next piece of equipment. It's not cash. The cash is gone. So that capital expense is actually how much money went out the door today for the equipment.
So it seems to me that you're never going to get to a positive number because you keep buying equipment. You can't start a company without having some equipment. So you start with negative dollars.
Okay, well let's do Swahili honey. Swahili honey started with, I don't remember let's call it $10,000 worth of stuff. So the founder scraped together $10,000. Maybe it was a grant, maybe it was friends and family, doesn't matter. You got $10,000 worth of stuff. So equipment to make beehives. So the raw materials to make beehives. He then made the beehives and sold them to farmers. So he made money on that transaction. So if it was, I don't even remember what a shilling is worth, but if it was 10,000 shillings in parts, he sold it for 15,000 shillings. He made a profit. Then the farmer went off and made some honey out of the beehive. Swahili honey bought the honey a few months later when there was honey, which is like 2 seasons a year, and then bought it for, let's just say, 1,000 shillings and sold it for 1,500 per kilogram. Made some more money, and they did that for 2 years before we met them. They were doing about 3 tons of honey when we met them. Then we invested 17,000 and change in them. It was 20,000 euros. With that, he bought more beehives. He then got a contract from the government of Tanzania to make them, I think it was 1,000 beehives. Like, they wanted to give them away. So he got paid for that. We didn't have the money for the parts, so we lent him the money to get the parts, then he paid us back. So all in all, there's been some money put in, but last year, I just got his financials. Last year, his profits were about 120,000 US dollars. So operating the company at $120,000 in profits, as in the cash in the bank, after all the expenses of everything, including capital expenses, the balance of the bank went up by $120,000. So now what he's doing is he's building a factory, because he thinks he can double the scale of his company by spending that $100,000 and something on a factory. And then if all goes according to plan, pandemic and aside, he'll have $200,000 in the bank next year. So then he can build 2 factories. And then he can build 4 factories and 8 factories, if it scales that way, which it won't. But then he can get to 2 factories and then 3, 4, 5 quicker and quicker and quicker without us putting any more money in. If we want to make it even bigger, faster, we could put more money in, and then we can speed it up. But that's a totally profitable company. One of those financial reports was his. I don't know which one. But his margins are incredibly good, and the company's doing really well. So when it works, it works. It does, in fact, we say that pencil out. It comes out to be positive.
Okay.
Looney, if our investee is asking for help with financial modeling stuff, how comfortable should we be asking them to look at their capital accounts or look at the details of what they've got? Or do you want us to just focus on high level, what they've put together and kind of spot checking it from our uneducated?
Go down the rabbit hole as far as you are comfortable.
Okay.
I have not seen, I can't think of any fledgling of the 101 so far that has tried to hide any of their numbers from a mentor.
Okay.
Not just investors, but those like mentor off the street. Like if they, and a lot of them don't understand financial modeling. So if they're saying what I really want help with financial modeling, they'll dump the spreadsheet on you. And I've seen where I say they should know what every cell is. I have seen mentors who have stepped up too far, who have been that outsourced accountant for them to build the model for them. Don't go that far. Don't do it for them. Show them how to do it. This is something that I always had trouble with when I was teaching the MBAs. I think always remind myself when I walked into that room that, especially when I was teaching the MBAs and fledglings at the same time, when a fledgling asks me and they get stuck, like, how do I do X? The first thing I'll just tell them the answer. But when I'm teaching at the MBA school, I got to go back to the Socratic method and not give them the answer, but help them find the answer. And so you can choose either path. You can give them an answer, or you can try and tease out from them the knowledge that they need so that they can do it themselves. But definitely don't go into the path of like taking the spreadsheet and reformatting it for them to make it right. Take the spreadsheet from them and send them back notes. Say, it's not quite Looney's format. You're mixing your capital expenses and your operational expenses in the same block. Right? He's going to yell at you for that. Don't do that. Split it out, as opposed to taking it and splitting it out for them, sending it back and saying, this is how you should do it. Or same thing, if we saw that one where the cost of goods had marketing in it, like don't move marketing down for them. Just point out that it's in the wrong spot.
Sounds good.
Yeah, same thing on pitch decks.